Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 30th of July. I'm Rajat Bhattacharya, your host for the podcast. Grab your morning coffee, sit back and relax because we just came out of a big event risk this morning, relatively unscathed. The Fed just decided to hold rates once again. And honestly, that's the outcome we were leaning towards all along. So here's the setup. Coming into tonight, markets were getting a little jittery, pricing in around a 35% chance of a surprise rate hike. That's up from just 10% a couple of weeks ago. The whole story was about new Fed Chair Kevin Warsh wanting to cement his inflation-fighting credentials. But in the end, he convinced his colleagues to sit tight and wait for more data before deciding anything for now. In the end, 9 out of the 12 Fed policymakers voted to keep the policy rate on hold, while 3 policymakers dissented, voting for a hike. And you know what? The overwhelming decision to hold rates makes sense. Think about it. The job market isn't overheating right now. It's actually pretty balanced after softening a bit in June. Core inflation has been well behaved too. Meanwhile, US wage growth is slowing. Oil, while remaining volatile amid fluctuations in the Middle East tensions, has cooled off back into that $70 to $90 a barrel range. So really, there was no urgent reason to pull the trigger now. Even though the Fed held, Warsh reiterated his aim to get inflation back down to the central bank's 2% target, similar to Warsh's playbook from his first meeting. And that matters because just talking tough had already tightened financial conditions and pushed up short-term government bond yields. Tighter financial conditions reduces the need for the Fed to actually having to hike. Nevertheless, this strategy can't be pushed too far, as the latest reaction from the long-term bonds show. Ultimately, incoming data will determine long-term inflation expectations. While they remain anchored for now, the Fed will have to act if incoming data show the job market and wage growth is heating up again, or oil prices stay higher for longer, adding to techflation pressures. We remain skeptical given the impact of AI on job creation and given our base scenario that oil prices are likely to trade in the $70 to $90 a barrel range as Middle East tensions de-escalate. So the bottom line is, the Fed decision supports our view that the Warsh-led Fed would prefer to wait for more data, and importantly, the outcome of Warsh's task forces expected by the year end on AI and productivity and more real-time inflation and job market indicators before deciding on the future path of rates. We expect the Fed to hold rates for the rest of the year. So what are the investment implications? Let's talk about stocks. A straight-up hold is neutral to positive for equities, as the initial reaction in equity markets showed last night. Some, though not all, of those July rate hike fears just got pushed back out to September or in the fourth quarter of this year. And the spotlight is likely to swing back to the second quarter corporate earnings season that is going on. So keep an eye on the big tech earnings in the coming days. That's likely to be your fundamental support. On bonds, the Fed's rate hold dragged short-term US government bond yields lower as markets pared back rate hike expectations by the year end. However, longer-term bond yields rose after the meeting amid concerns Warsh is not fully committed to fighting inflation. Nevertheless, investor positioning is extremely bearish, which is likely to limit further rise in bond yields. The 10-year yield is likely to face strong resistance around last year's high of 4.8%. On the dollar, the Fed's clear 9 versus 3 decision to hold the rates reduced expectations of an immediate rate hike and weakened the dollar. But it did not mark a clear dovish policy shift. Investor positioning has been super bullish actually around the 85th percentile. So a Fed rate hold sparked some positioning squaring. Lower short-term US yields may support the euro, the Swiss franc, the Aussie dollar and Asian currencies, while higher long-term yields and renewed oil risks could limit further dollar downside. The Bank of Japan's policy decision tomorrow is the next major catalyst for global FX markets. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a productive day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.